Most of the cool and popular stocks are listed on the NASDAQ exchange, including the iconic FANG stocks, as well as other popular technology companies. So these companies are very hot and have provided a lot of growth for investors over the years. But what about for us income-focused investors who really invest to maximize our passive income streams? Is there a way to invest in these great companies and get a lot of passive income at the same time? Well, the answer is yes, and once again, a covered call ETF is the answer. QYLD is a covered call ETF and an index style ETF all in one package, and it provides a mind-boggling 11% dividend yield. How is this possible? Well, let's explore the ETF together in detail to find out. In case you were not aware, there are two big stock market exchanges in the US. There's the New York Stock Exchange, commonly referred to as Wall Street, very iconic place in New York City, close to that famous charging bull statue, which is right over my head here. But then you also have the NASDAQ exchange, where all the tech giants are. So this exchange has no physical location. Everything is done electronically. So there are a few popular and really big indexes that measure or track US stocks as a whole. You have, of course, the Dow Jones, the S&P 500, the Russell 2000, but then there's also one called the NASDAQ-100 index. So this index is what the QYLD ETF is based on. The NASDAQ-100 index is simply the 100 biggest companies listed on the NASDAQ, excluding financial companies. So the primary sector, like you probably guessed, in this index is technology, close to 50%. It also has some telecommunications, some consumer stocks, as well as some other sectors. But like I said, it's primarily focused on technology, and it does not have any financials whatsoever. QYLD is a covered call ETF as well. And as many of you already know, I'm a huge fan of them. Covered call ETFs were really designed for one thing: to provide investors maximum income over growth. So they do this by selling call options, which generates premiums. And these premiums are really the reason why these types of ETFs have high dividend yields. Now, I won't go into detail about covered call ETFs in general in this video, as I already covered it in a past video. So if you have no idea what a covered call ETF is or how they work, I strongly suggest you check out that video, which the link should be flashing on your screen right now. But in short, I'll give you a quick summary. The covered call strategy, which covered call ETFs obviously use, is a zero risk way. I repeat, a zero risk way to get a really nice enhanced dividend yield by sacrificing some share price upside. So for a long-term buy and hold passive investor like myself, whose focus is really primarily making as much passive income as possible without the intent of ever selling shares down the line, covered call ETFs are a real dream come true. So who manages this ETF? Well, it's managed by a company called Global X, and the parent company of Global X is Mirae Asset Financial Group, a company based in South Korea, believe it or not North Korea. And they also own, by the way, Horizons ETFs, another one of my favorite ETF providers here in Canada. So let's go to the fund's homepage and see what this ETF is all about. So here it is, guys, QYLD. Here's the homepage. Like I mentioned, it's from Global X, which is owned by Mirae Asset Management. So if we just read the fund summary here, so the QYLD ETF follows a covered call or buy right strategy in which the fund buys the stocks in the NASDAQ-100 index and writes or sells corresponding call options on the same index. So in terms of management fee, it's pretty decent at 0.66 here. That's the gross expense ratio. And if we look what's actually in the fund, you could scroll down and we could see the top 10. So this basically follows the NASDAQ 100. So what are the biggest companies on this NASDAQ? You should recognize all the top 10 ones here: Apple, Microsoft, Amazon, Tesla, Facebook, Google, Nvidia, PayPal, and Comcast, which is NBC, I think. And if you want the whole breakdown, you could actually, or all the 100 companies, you could actually click here on full holdings, and you will get an Excel file. And as you could see here, the top 10 are here. But you also have other ones that you will recognize, like Adobe Technology. Netflix is here, Intel Technology, you have Pepsi, Cisco, another big technology company, etc., etc., etc. So all really popular and really giant corporations, very profitable and lucrative corporations in the United States. And if we look at the distribution, so at the dividends, click on the calendar, and you could see that this fund started in 2014. So if you look at the history, it's actually pretty consistent. I looked over them a few times, and I could see that the dividend is really good. It's usually it averages about 20 cents a month. So if you go throughout the year, sometimes it's higher, sometimes it's lower. But it's usually about, on average, I would say 20 cents a month. 2020 was a pretty good year as well. They had really nice dividends here. You could see them here. See the breakdown every single month. So those are the distributions. What is the yield? Where you could see here the 12-month trailing yield. This is what I look at when I look at dividend yields for ETFs that have a varying dividend every month. So this is the average for the last year. It's 11.59%. So you see that I was not lying here. The current distribution yield, this is if it's based on the last distribution, which was 22, almost 23 cents, is a little bit higher on at 11.75. So really stellar distribution yield here. Really amazing. So you could always read up on this page yourself to do a little bit more research. You could click on the fact sheet here, which will bring you to this document, which covers a lot of the stuff that I already mentioned. But if you scroll down, you could actually see the sector breakdown, which is interesting. No surprising, technology is the highest at 50%, but there's also communications, which is companies like AT&T, Verizon. There's consumer, healthcare, consumer staples, etc., etc. But most of it is technology. And if you scroll down, you could actually see the description of the NASDAQ-100 index as well. So the NASDAQ-100 index includes 100 of the largest domestic and international non-financial companies listed on the NASDAQ stock market based on market capitalization. So it's just saying that the NASDAQ-100 index is going to have the 100 biggest companies that are listed on the NASDAQ, excluding financial companies. So last thing I wanted to show you is that if you actually go to related ETFs and look at some of their other ETFs, scroll down to Covered Call here, where you see their suite of Covered Call ETFs, QYLD being the one we just saw. They also have other ones that track the S&P 500, the Russell 2000. And another interesting thing I just want to point out to you is that they have kind of like a baby brother to QYLD. They have QYLG, which is called the NASDAQ-100 Covered Call and Growth ETF. So what this ETF does compared to QYLD is that it sells the covered calls on 50% of the you could see that here, 50% of the portfolio instead of 100%, which is what QYLD does. So this is a good way to get a good balance of income and growth as well. So because it's selling covered calls on only 50% of the portfolio, your share price, if the NASDAQ 100 does really well, you're capturing a bit more share price increase. So QYLG might also be another good option for you guys who want to really balance a bit of income with growth as well. But of course, it's no surprising that the dividend yield will not be 11%. Last I checked, it was actually about half of that at a little under 6, which makes complete sense considering that it sells covered calls on only half the portfolio, right? Half the portfolio, so half the dividend. But QYLG, still a pretty good option if you want some growth as well. There you go, guys. That's how QYLD works. One very important thing to keep in mind that this is a US listed ETF. It's listed on the NASDAQ. So what does this mean for Canadian investors like myself? Well, it means that there will be a 15% withholding tax on the monthly dividends that you receive from this ETF, just like any other dividend from a US listed stock. Now, you don't have to actually worry about paying the 15% tax yourself. I just wanted to be perfectly clear. Many Canadian investors get confused about this, and I get questions about this all the time. So the 15% withholding tax is taken off the top automatically before the dividend even reaches your account. So I repeat, the tax is taken automatically before the dividend reaches your account. So you don't have to worry about it. This, of course, applies for not only a cash account, so a non-registered regular cash account or margin account, but also applies to the TFSA account. I know it says tax-free savings account, but that's really for Canadian dividends, okay? If it's a US listed stock that gives a dividend, you will be subject to the 15% withholding tax, even if you hold it in a TFSA. Now, if you hold QYLD in your RRSP account, there is no 15% withholding tax, okay? It's the only way to avoid this tax, by having it in your RRSP, simply because the RRSP is considered a retirement account. That's pretty much it. So I discuss all this in detail in a recent video I made regarding taxes. So check out that video if ever you want to know more details about this 15% withholding tax. Personally, we hold QYLD in 3 accounts: my cash account, my RRSP account, and my wife's RRSP account, for a total of about $45,000 invested. That's how much we love this stock. I strongly believe that this is a great stock to own if you want a high passive income. Do not ignore this stock simply because of that 15% withholding tax. In my opinion, it's a big mistake. It's still worth it to own it in a regular cash account or TFSA because even with that tax, it still gives you a solid dividend yield of over 9%, and it's a great way to really get exposure to the tech companies, most of which don't even offer a dividend in the first place. Also, keep in mind that this stock or this ETF is designed for income and not capital appreciation. I already sense the negative comments coming about this ETF. Look at the share price of the ETF over time. It doesn't grow much, or the share price trend is not good, etc., etc. My response to that is I really don't care. I don't care about stock price, the trend, or the returns based on share price. I am a buy and hold income investor. I do not intend to sell my QYLD shares in the future. So why would I care about the share price or the share price trend? If you want growth, this ETF is simply not for you. It's not designed for growth, it's designed for income. If you want growth, you're much better off investing in a non-covered call ETF that replicates the NASDAQ-100 index, like the ZNQ ETF from BMO, for example, which does just that. Or like I showed you earlier, you could invest in QYLG. So change that D to a G and you'll get another ETF which is very, very similar. And like we saw, it sells covered calls on 50% on the portfolio instead of 100% on the portfolio like QYLD does, which means you're sacrificing a bit of income for a bit more growth. So it's really 50% growth, 50% income. You really need to make your own decision based on your investment strategy and philosophy. Personally, I want 100% income, so QYLD is what I'm investing in. I hope you enjoyed the video, guys. Please support me and my channel by hitting that like button. It's free for you and helps the channel out a lot, so it's a win-win and it's much appreciated. Finally, make sure you're subscribed so you don't miss out on my future content and community posts on passive income investing, which is all designed to really help you on your investing journey. My mission remains the same, guys. It's to help everyday working Canadians to invest on their own in order to build their own stream of passive income to enhance their quality of life. So with that, take care, guys. Stay safe and see you next time.